buyer, somebody or a young person looking to buy a home, you need a bit of a reset.
There is a possibility on the other side of this that inflation could actually be quite low.
Welcome back to Real Estate Mindset. Good morning to you guys. Happy Monday. It's absolutely wonderful to start this morning with you guys. If you can, I'm having a little bit of audio difficulties. If you guys can, let me know that my audio is doing okay. Now, today's theme during this entire video breakdown is we're going to re-explore maybe the new or the redefined bullish narrative on why the housing market is not going to crash. So I'm not sure who's online right now. I see you guys. Good morning to you guys. Let me know if Comic Lover, if you're on, let me know. House Hacker, I know House Hacker's on. Now, here's the thing. Both House Hacker and Comic Lover, who are a part of the Real Estate Mindset community, that's why I mentioned them, they believe that the housing market essentially is not going to crash. They're specifically Comic Lover, and I want to explain this because great points, right? We can analyze what they're saying and respond to that. So their points are specifically Comic Lover. We have, as buyers, essentially, there's Comic Lover. I see you, brother. So comment below if I get anything wrong, Comic Lover. This is my man. This is my dude right here. This dude is a great analysis. He's always researching things. I really appreciate it, Comic. We don't always, get everything right, but I really appreciate it, man. Definitely appreciate that. So here's the thing. Comic Lover and a lot of investors, actually, predominantly people that are in good positions, what they believe predominantly is going to happen is we're going to have, as buyers on the sideline, one more opportunity to purchase. The opportunity coming right now. So again, they're saying January, February, December is going to be our last potential window to purchase a home without overwhelming buying demand. The reason that they're saying that is this. They expect interest rate, and so does the market, and we'll cover this. You guys, I have so much to cover with you today. We're going to do a really in-depth breakdown. But essentially, they're saying one more opportunity, because when interest rates are cut, which they're expecting it to be cut next year, buying demand is just going to flood back in, and we're going to be in a similar problem that we're in right now. So I want to talk about that. And I believe that, that basically that narrative, I think what we're really doing there, guys, is we're putting the horse before the cart, okay? Because we really have to understand this, and we really got to look ahead. Why would the Federal Reserve slash rates? Why would they do that? And we can pretty much all say unemployment, right? Sometime or a potential systemic failure. So I want y'all to understand that the Federal Reserve is not going to drastically cut interest rates unless unemployment becomes unhinged. And also understand, and we're going to take a look at this further on in this video, that and the reason I use word unhinged is once unemployment starts picking up, it usually lasts for an extended period of time. And that's generally why the Federal Reserve has to cut rates. And they cut rates substantially. And I'm going to show you guys that as well. So understand that if they do that, unemployment is going to be unhinged. And more than likely, if we have an unemployment crisis in America, which a lot of people are expecting that to happen next year, people probably are going to be more worried about living versus buying an overpriced house that they can barely afford. So I want you guys to understand that the Federal Reserve is smart enough to know that if they lower rates and they're not, an economic uncertainty or challenge hasn't happened, then all of the work that they've done over the last year and a half is for nothing. Do y'all understand what I'm saying? It would have been for nothing. So they're not just going to lower interest rates. Now, the market, however, wants them to, but also understand, guys, and we're going to check the market here in a minute. The market's always wrong. Literally, they are always wrong when it comes to the Federal Reserve. Tell me one time they've been right. Tell me one time they've been right. They're always, every single time they're wrong about the Federal Reserve. So I think it's important to, yes, look at the market, but also pay attention to the Federal Reserve and historical precedent. And we're going to go over all of that stuff again today, guys. So we'll start our market update. A little bit of a ramble right there. Apologize for that. We're going to get started, y'all, right now. Let me see if, okay, good. I have this set up. So let's start with the interest rates. Let's start with the money. And I'm going to give you guys a huge breakdown on the overnight reverse repo. We'll look at M2. We'll look at the inversion. I watched a really good video that Jack made a couple days ago that the guest that he had on, I think he was an economist, but he went into the reverse repo market and what that would do. And once that ends, once that runs out of money, what would happen to the economy? once that money runs out. It's a very, very good video. So I'm going to attempt to do the same thing, kind of break that down very quickly here. But here's where we're sitting at the 10-year treasury. So the 10-year treasury this morning is elevated, but it's sideways. It's only up about 2 basis points. We got up to about, 3-4 basis points, but it's kind of been going back down. Not a lot happening with the 10-year. Overall, y'all, last 2 weeks, it's been going down, and it's been going down substantially. I see you, Jeff. I see you. Nice to see you. But anyways, guys, we're sitting at 4.48. That is high for everyone, especially companies. So this is absolutely killing the economy right here. If you want to know what's going on, what is hurting the economy, this is a big reason why the economy is getting hurt right now, and the challenges exist. It's the 10-year treasury. It does remain elevated. Now, the shorter end of the treasuries, the shorter end, okay? This is a liquidity zapper. This is actually what's burning, the shorter end, not just the 1 month, but this is what is burning the money out of the market. And I'm going to show you that here in a minute, but this is up, okay? This is 5.36. Now, here's what's important. It's important that the shorter end of these yields has higher interest rates than the reverse repo market. We've been covering that a lot. Remember, the reverse repo market is offering 5.3. So the higher their shorter end, like the 1 month, 6 month, things like that, the higher those rates are, the more the money will run out of the reverse repo market. But here's the 1 month, guys. Let me show you now the reverse repo market. This is a huge thing to watch. Now, this is absolutely crazy, okay? This has been literally plummeting. This has been plummeting again. We are off the stair step, and we are headed straight down. Now, what I want to explain, guys, is when this money is gone, the Federal Reserve, or rather the government, the Treasury, they're going to be in big trouble. Because right now, the Federal Reserve is essentially borrowing money from the reverse repo market, taking the money and burning the money. So the reverse repo market is a very, very intriguing, very clever set of data to monitor, because this is the COVID. This is the COVID money. This is why this recession is taking so long. I thought the recession was going to start this year. This is the one primary reason why it has not started, is all of this money. This is plummeting, but let me show you guys, okay? Take a look at this. Let's go to the M2 real quick. Now, the M2 is the total money supply. Okay, so it's the total money supply in the US. Now, remember, the last time we had decline in M2 was during the Great Depression. When the M2 money supply is going down, that generally signals challenges in the economy and over-tightening from the Federal Reserve. Over-tightening, that is necessary. But the M2 is going down because of quantitative tightening. This tells us how much the tightening is impacting us. But there's still liquidity in the market. And I also want to point out this, and I love that they made this point. Now, remember, guys, again, this is the first time in 70, 80 years? So this started going down about April of 2022. Do y'all see that? Okay, so it was going down. We're making progress, like, oh my gosh, the Great Depression's coming. The Great Depression's coming. But I want you guys to understand that around May of this year, you see it plateaued. Okay. Now, what I suspect is, and this is crazy. Okay. This sounds crazy. That is going to start going down again. I suspect, listen to me, unless actually, I think there's going to be a bailout probably in 2025, but I don't think it's going to be a consumer bailout. I think it's going to be a government bailout. And I think they're going to use the M2 money supply to demonstrate that the government needs to be bailed out. I think the M2 money supply is going to start going down at the beginning of 2024 once again, because we have to ask ourselves, why did this stop going down? Do y'all know? Okay. So again, it stopped going down around May. So if you look here, you guys, okay, around May, look at the reverse repo market. Notice that the reverse repo market also started going down in May. Why is that important? This is important to understand because this is what is holding up the M2 money supply right now. Okay, we can see that now. I love the video that I watched. I'm like, oh my God, this all is starting to make a lot more sense. The M2 money supply is being propped up by the reverse repo market. You can see it start going down. It started going down when the M2 started going sideways. So the quantitative tightening is working. The problem is we just have to continue to burn the rest of the money. And that's exactly what we see happening. And we can now follow it. Okay, so when this goes by, when the reverse repo market goes bye-bye, economic uncertainty is going to spiral. Okay, we're going to have all of the commercial real estate, all of this stuff is going to spiral because again, M2 is going to start going down once again. However, Also, what's important to understand is when this goes away, okay, it's probably going to take a little bit of time for the uncertainty to start to hit and for the M2 money supply to go down. Because remember the Treasury. Here's the Treasury. So the Treasury still has $738 billion in their general account to spend. So again, this is what has to happen. And probably this is what's going to happen. This money goes away. Probably, hopefully the beginning of next year. It is plummeting. This is a reverse repo market. Once this money goes away, we're in trouble. But it's okay. Because guess what, guys? They're probably not going to do any more bailouts until we get another president. At least that's what I hope. Okay. Once that goes away, this is what's got to go away. So once this goes away, what is the government going to do? The government's got nowhere else to go but potentially to bail themselves out and money print for themselves. That's what I believe is going to happen as long as there's no additional bailouts in 2024. That's the scary part about all of this. Every single bailout messes us up. But let me show you guys now the inversion. First of all, I hope that made sense to you guys. So watch the money. Watch the money, right? But let's see what this is doing to the inversion. Now, I want to talk about the recession because people are like, first of all, you guys, remember I started at the beginning of 2022 around March of 2022. Remember, I almost died from COVID at the end of 2021. I was in the hospital and fighting double COVID pneumonia for like 3.5 months or something like that. Anyways, so here's the thing, the recession. Let's talk about it. Because I get the comments, you're talking about the recession for a year. So when anyone says that, oh my gosh, you're wrong because you've been talking about the recession for a year, does not understand, for the love of all that's holy, how recessions work. They don't understand it. Now, again, I jumped the gun a little bit. I expected the recession to start this year because of the overwhelming quantitative tightening, M2 money supply is going down. But there was still so much money in the economy. We averted recession, plus also the discount window didn't help as well. Now, here's the 10 and the 2. And I also want to point out this. The great financial crisis, okay? The great financial crisis, the yield, the 10-year and the 3-month inverted, and it took 22 months to go into recession. So because right now with this economic uncertainty, being that we have so much of that excess money, so much of that money printing, the M2 money supply is bigger, I think it's going to take a little longer for the tightening to cause the recession. Isn't that fair to say? I think that's fair to say. There's more money. It's going to take a little bit longer to go into recession. 22 months, you guys. So just because we've been talking about it for a year and a half, doesn't mean it doesn't exist. That is a horrible, naive comment to make. Again, look at the historical precedents. How long does it take for a recession to hit? So again, you guys remember, unfortunately, we have to be patient. Now, the thing is most of society is not patient because patience is difficult. That's why patience is a virtue. But if you're patient, I think we're going to benefit from all this. I really, really do. And in fact, I'm putting my money where my mouth is. I'm actually renting right now, holding off from buying. But again, you guys, here's the 10 and the 2. We went more inverted. That's why I'm saying this. We're now 44 basis points inverted. I mean, we were doing great. We had the bear steepening, which means reversion was near from the longer end of the yields. Okay. But that started changing when? Sure. Okay. Well, first of all, it changed for 2 reasons. When Israel got attacked, but also because the market does not think the Federal Reserve is going to hike rates anymore, okay? So you see it inverting even more. Now, the reason I'm telling you guys this is because, again, it may take longer for us to head into recession. We may be in recession right now. We may have negative GDP. But what I'm saying is, if we just look at this, okay, if we're only looking at the inversion of the yields, we still have more pain to go through before recession. Okay. And I'm going to get to my points here at the end of the video, but we definitely have more pain to go through. We are not there yet. And it is a little bit, it is a little bit surprising. But when we think about the amount of money that was printed, I mean, it does make sense. And when we think about how the money was printed and distributed to the public, I mean, it does make, it does make more sense. It went straight into the bank accounts of the consumers. So it's really, really interesting stuff, guys. We're going to go into our first video now. And our first video is about first-time home buyers. It's only about 3 minutes. Now, after this video, we're going to do our mortgage update. We'll look at the 5-year break even. And then I'm going to show you guys mortgage rates and how the market is trying to rug pull us now. The market is trying to rug pull the Federal Reserve. Don't fight the Fed. The market keeps fighting the Fed and they keep getting it wrong. And I'm going to show you that in a minute. But we're going to listen to our first video right now. You guys, please, if you guys can, let me know that the audio is okay. and I would definitely appreciate it.
Market to buy a home? Well, you're competing with the typical home buyer whose annual income is at a record high. The typical home buyer is raking in $107,000 per year. This is according to a report out this morning by the National Association of Realtors. Jessica Lotz, National Association of Realtors Deputy Chief Economist and VP of Research, is here to break down this report for us. Thank you for joining us this morning. So, as we're looking at especially these first-time home buyers, they made up 32% of all home buyers, up from last year's historic low, but still below average. But talk about the demographics. Who are these home buyers who are snapping up these deals?
Well, they're wealthier. We know that the typical home buyer, especially for a first-time home buyer, they're essentially making nearly $25,000 more than they were last year. So they have to be higher earners to actually enter into today's housing market. They're also tapping their assets. So they're looking at their stocks, they're looking at their 401k, even cryptocurrency to put down as a down payment.
With that said, I mean, this is a really tough market. We talked so much about the higher rates, specifically on the 30-year fix, but also the fact that there are those who are looking for their second home who have equity already built up. So how does that stack up for the first-time home buyer when inventory is so limited?
Well, that's the thing. And that's why we're seeing still historic lows of first-time home buyers, is because inventory is incredibly limited. If there's a multiple offer situation, that repeat buyer who can put down a larger down payment than they have historically is going to win out on that bid. And in fact, we've seen actual down payments go up to a 20-year high, both for first-time and for repeat buyers. And I think that speaks to first-time home buyers saying, look, I have the money. I want to enter into the market too. Please accept my bid. But we're still seeing that repeat buyers are winning out.
And I want to talk about household composition and how much that's changed and how that's affecting who's able to afford some of these homes and where they're buying.
Right. So we're seeing that married couples are dropping, but what we see overall in the US is that there's generally a smaller share of married couples today. So we see more single women entering into the market. I think this is amazing. We see that they're competing against these repeat buyers who have higher incomes. They're saving for longer periods of time. But I have to say that housing affordability is going to impact these singles more than we would see for married couples.
Obviously.
Jessica, that 30% that you alluded to at the top of first-time home buyers who are snatching up these homes, how does that compare historically?
So historically, we've seen that first-time home buyers are 38% of the market. So we do still see that they're lower than what they have been historically. Yes, we do have a higher share this year than last year, but we're still near historic lows, unfortunately.
Okay, guys. So before I move on to the next section, let me bring up some comments that I appreciated real quick from Mr. Ringer. So Mr. Ringer, and I think that brought a couple good points. I think it will be pretty cool to talk about. Now, Matt, okay, so this was a mad respect to you. Thank you, sir. But I'm tired of hearing about how the direct-to-consumer stimulus is what propped up this broken economy and market. It was really nothing. So let me talk about this, because then he makes another comment where very, very good comment. His next comment was very, very good. But let me explain this real quick. It actually was a very big deal. And I know it was a very big deal because I'm in consumer direct business. So being in mortgage, I know that the stimulus and that money printing drastically impacted consumers' ability to afford a house by the down payment. The stimulus acted as a down payment for people, and the down payment for most consumers, not all, but for most consumers, is the hardest thing to come up with when purchasing a house. Can you believe that? It should be the easiest thing, but whatever. We're in a horrible environment. So I understand his point, though, because of his next comment, but I also want you guys to understand what 70% of GDP is made up for what? Consumer spending, 65, 70%. So it matters a lot, but that's not all. So they went on to make this point. Take a look at this. And he's good right here. QE and PPP loans are the major issues that this came from. Well done, sir. I would agree with him that this is a bigger problem. So the consumer things, sticky, down payment, going direct, inflation, right? However, what their point right here, that was the bigger problem. The QE was the bigger problem. And what do I mean by QE? Low interest rates? Not necessarily low interest rates. Mortgage-backed security purchasing. You guys, when the government purchases mortgage-backed securities, the lenders can lend at lower interest rates. Because, for example, say Chase Mortgage offers me a 3% mortgage, they barely make any money. So Fannie Mae or Freddie Mac purchases those, right? Or the Federal Reserve government purchases those loans at those low interest rates so the banks can continue to make money. Okay. So in other words, if it wasn't for the government purchasing the mortgage-backed securities as well, interest rates would never have been that low, even though they lowered the federal funds rate. Because remember, the federal funds rate does not track mortgage interest rates. And I'll show you that here in a minute. Okay. Great comments. Absolutely great comments. Sorry, I missed that because you're 100% right there. Okay. Sorry, I missed that. Now I want to go over and talk about the mortgage report now. Let me throw up this timestamp. I really appreciate each and every one of you guys here. I'm really excited about my trip coming up. Super excited about that. I'll tell you guys about that here in a minute. So let's go over our next thing right now, which is going to be right here. So now we need to figure out, okay, let's continue to talk about interest rates. When is the Federal Reserve going to start dropping interest rates? Well, right now we have to understand, well, that they lie to us, but they're battling inflation right now. So they're battling inflation. So in order for them to cut rates, inflation has to be under control. And obviously something is probably going to have to break. Here's the 5-year break even. This is going down. Remember, this shot up and I was like, oh, this is really bad. This is really bad. But it has been plummeting. So this is one of the reasons why the market is trying to rug pull us, because the expectations for the 5-year break even inflation rate has gone down to 2.2. It's now at 2.23. So keep watching this. Very, very interesting. Now take a look at CME now. And here's how we know that the market is trying to rug pull us as far as additional rate hikes by the Federal Reserve. You can see, looking at December, the market has taken off completely, has given absolutely zero reservations about another rate hike. Zero. Look at this. They are saying there's zero. Look at, there's zero. To the right of this, there's zero. But to the left, there's 0.2% chance of a rate cut. They're saying it's more likely that there's a rate cut than a rate hike in December. They get it wrong all the time. Okay. Look at January. And again, this all changed after the new inflation numbers came out. Now, January, same thing, you guys. The market is, the way I'm looking at this, is trying to strong arm the Federal Reserve back and say, you are not you're not raising interest rates because inflation is under control. Okay. Y'all understand what I'm saying? But the reality is, you guys, inflation's not under control yet. We are making progress, but it is not there yet. Take a look at this. This is super depressing, you guys. So March, we're still good. We have a 70% chance to stay elevated by March. I like that. That's when spring home buying season comes back. I don't want to see what happened this year and a whole bunch of first-time home buyers specifically going out purchasing overvalued house with the premise that they could just refinance next year into a lower interest rate, but they fail to realize it costs money to refinance, and you have to start your whole amortization schedule again, and you have to qualify. If you're purchasing homes and you're a first-time home buyer with the expectations to refinance to be able to afford your home, I'm going to tell you now, you are not purchasing your home the right way, responsibly. Okay? And I want you guys to purchase responsibly, because when we go into the recession and unemployment becomes unhinged, we're going to need to be safe. We are going to need a cushion, because this is going to be painful for a lot of us. But let me keep going, guys. I'm sorry for that. All right. So here's me. I see Todd is here. What's up, Todd? Oh my gosh. Did Todd tell you what we're going to do? Don't tell them yet, Todd. I mean, you could tell them. You guys, me and Todd, I'm going to save that for another video, but me and Todd are going to do some crazy stuff. I can't wait to tell you guys about that. But here's May. May is saying 38.6% chance to stay elevated. That is under 50%. I don't like to see that. Again, because that is when buying season starts. Now, again, if unemployment becomes unhinged during this time, it's okay, right? Because when unemployment becomes unhinged, you can't just turn it off. It starts spiraling. Again, I'll show you that here in a minute. But look at June, you guys. June is just super depressing. Only a 17% likelihood that we have elevated interest rates where we're at right now. And July has gone all the way down to 8%. And I've been watching that like a hawk, because that is very important. Now, again, this is okay if they start cutting rates in July, if we are ready as a nation. If we are not ready as a nation and there's still all of this buying demand on the sideline, it is going to wreck us, and they're going to waste the time, and we're going to be in an even bigger mess. Okay. But like a lot of people are thinking, okay, the labor market's already starting to crack apart. Once that thing starts to implode, it's not stopping. So if it starts to implode, again, the beginning of next year, it may be okay with the interest rate cuts. And I'm going to tell you guys this, the only way we're going to get a substantial interest rate cut is unhinged unemployment. And when unemployment becomes unhinged, they got way more problems. Consumers have way more problems than overpriced houses. They have problems with the ability to live their life. That is a way more majorly important thing than having a overpriced house roof over your head. But let's look at interest rates, you guys. So interest rates are still elevated. This is good, but we want them much higher. Right now, they're at 7.37%. And why do we want them much higher? Because we need balance back to our housing market. You guys, I'm not even going to go into Airbnb. I have a video I'm making about Airbnb. Geez Louise. They're trying to do so many workarounds to these new regulations. It's just shocking to me. So many workarounds to the Airbnb bans. Anyways, you guys, we're at 7.375. Let me tell you how expensive that interest rate really is. And by looking at this amortization schedule, and I'm really going to take you guys through this, okay? So again, looking at the amortization schedule, this is a horrible debt. A mortgage is a horrible debt. It is similar to credit card debt in that you make the banks filthy rich. Not a little rich, filthy rich, filthy, okay? And the reason that is because they're front loading these loans with the interest. You do not pay even principal and even interest payments like you do an installment loan or a car loan. Amortization schedules like the bank gets rich before you pay the loan off. That's how this works, you guys. So I want you guys, we're going to not look at year one, okay? What I'm going to do, all right, because I can't give personal financial advice. What I'm going to do is after I buy my house, I'm going to wait a year. And during this year, I'm going to rebound. I'm going to recover if I need to because my down payment, because my moving expenses, my utilities, all of this stuff, I'm going to recoup during year one. Now, when year two hits, now that I understand how bad these amortization schedules are, I'm going to start paying my amortization schedule down on year two. Okay, so this is year two right here. And I want to show you guys how to save all of this interest, these 4 lines of interest right here. All you would have to do that is once year two starts, you pay your principal loan balance from $321,560 down to $309. Doing that would require $11,619, but that would save you 4 years and $93,727. You guys, here's the thing, okay? I just want to get you there. Once you start understanding these amortization schedules, you could do whatever you want, but I got to get you there, okay? So let's get a year two, throw $10,000 on that sucker, save yourself almost 100 grand, and you're good. But now let me show you this. This is bad. Now, how many people purchased with the idea that they're just going to refinance? A lot of people, would you say? Because that's what they were being told by the professionals in the industry. Would you say that's accurate? Here's the thing, you guys. Let's look at how much that would cost. So say someone, let me highlight this, okay? Let me highlight this in yellow. Say someone owns a house for 3 years and then they're going to refinance in 3 years. I want everyone to understand that if they were to refinance after 3 years, do you see these first 3 columns of interest right here? That starts over again. So the amount of money that they would have wasted in just interest for the first 3 years, and then they do a refinance again, is $71,000. It is way more expensive to refinance than most people think if there's a big if here, you're not playing the amortization schedule game, okay? You have to attack that bad boy right there. If you don't attack that amortization schedule, you will be a prisoner of financial debt to whatever bank wants to buy your loan that month, okay? Think about what I'm saying. I need to get you here. Even if it's $500, let it be $500. But again, if you refinance that first 3 years, you start this whole thing over again. You threw away $71,000 in interest. So maybe it is okay to rent sometimes, especially in times when there's quantitative tightening in the world's biggest asset bubble in history, which is the housing market. And that is a fact. So anyways, that's the amortization schedule thing. Let's see here. What do I want to do now? We're going to go into our next video. And this is, what's our video now? This is, okay. This one, okay, so this is a little bit longer of a video. This is going to go into how strong the consumers are, okay? So it's going to go over how strong the consumer is, but I'm going to tell you guys right now, the consumer is strong until they're not, okay? And again, after this is going to be a really good segment of this video. After this, we're going to go into the federal funds rate, unemployment, the great financial crisis, and mortgage-backed securities purchased by the government.
On the global market is Jean-Yves Filioni. He's the vice chairman of BNP Paribas USA. Welcome. It's good to see you again. Thanks for coming down here and sitting on our set.
Thank you so much for having me, Scott.
So, you know, what makes a market is, you know, differing views on where we are. We just had a vigorous debate about whether it's time to be bullish or bearish. The bears had won out for a while, but how does the environment feel to you today?
The data of the week was quite positive. Inflation's coming down, probably at a faster pace than expected. Retail sales are coming down as well, but probably not as fast as one would have feared. And this U.S. economy seems to continue to be very resilient in spite of the headwinds. And I think this is what the markets are recognizing, right?
Yeah. Are you surprised by how resilient almost everything is? I mean, the consumer's been resilient, the economy's been resilient, the market's been resilient.
Not so much. Spending a big part of my time with business leaders. I was actually last week with some of the largest, tech CEOs. This economy continues to have strong fundamentals. Corporate balance sheets continue to be in a good shape. Very liquid. The consumer continues to spend. And the velocity of capital markets here is just unprecedented.
Yeah, I mean, you are talking about some of the most well-known CEOs out in Silicon Valley that I know you've been with lately. What sense are you getting from them on enterprise spending? The very things that the market is concerned about that would be first hit in a more dramatic economic slowdown.
There is concern about the geopolitics and politics situation. We have to be very clear on that. It's in everybody's mind. However, I see them very involved and engaged in terms of investing, expanding internationally, by the way, where the bank is pretty well positioned to support them, having a presence in 62 countries in the world. What they need mostly is they still need lending and actually at times bridging to capital markets, expecting better conditions. They are very focused on the more, I would say, industrialized ones on, short-term financing, trade, receivable financing, supply chain financing. But I would say I would be remiss if I were not saying that given the uncertainty and the potential expected volatility, we've had unprecedented demand on hedging strategies. And Scott, across the spectrum, obviously it starts with rates, with currencies, commodities, given the status of energy and equities.
Okay, so since we're talking about demand for financing, let's talk about rates. Have we peaked? Do you think we have? Do you think the Fed's done? Let's start there.
I think central banks, and I'm putting an S here because I think there's a common view between the Fed and the ECB, acknowledge the good trend in terms of inflation. But when you look at inflation, I think we have to make a distinction between holistic inflation, between core inflation, and between services inflation. And this the latter is probably the most steady. However, I don't think anybody claims victory on this battle.
Yeah, well, that's clear. You're getting that, including from the Boston Fed president who was on our network today, Collins. Let's listen to what she told our Steve Leisman, and we can react on the other side of that, Jean-Yves.
3-month core is still at 3.4%, Steve. That's higher than we want. And so in order to get back down to 2% in a reasonable amount of time, we need to be patient and resolute. And I wouldn't take additional firming off the table. We need to look holistically at the data.
This is kind of the message you're getting from everywhere, correct? Too soon to declare victory, but we can afford to be patient.
There is always a debate about is 2% the proper benchmark going forward.
What do you think? Because do you hear Jim Gorman this week? Who said what? Maybe it's not. He said maybe 3%.
Then I think there is a good discussion. And I wish I had a crystal ball on this one, right? However, what I have more certainty about is this is the end of cheap money, and this is the end of cheap labor. The house view for 2024, we see the Fed and the ECB, sticking to their policy. Probably we've reached a stage where terminal rates are probably where they are, but we don't see any cuts until the second half of 2024.
But
and as you know, central bankers are fact-based and driven by data. Then that's going to be the main driver in the next few months.
Do you think they cut because they can, because inflation's come down on trend, or do you think they cut because they have to, because the economy's weakened to the point that they have no choice?
And I think you're just highlighting the dilemma. They have to manage this very fine line between fighting inflation and keeping this economy going. I have to say, as it relates to this economy, this is such a resilient economy that they might have a bit more room to maneuver than the ECB might.
Who cuts first? Who cuts first, Lagarde or Powell? I'm putting you on the hot seat now.
I was going to ask you, that's what I came over today. Well, listen, what's interesting to see here, there is convergence between these two central banks, in terms of money, first and foremost, in terms of oversight, supervision, in terms of monetary policy. If there is one difference still, the Fed has been using in their toolbox rate hikes, as well as unwinding the balance sheet.
QT, quantitative tightening.
90 billion monthly. The ECB so far has only or mostly used rate hikes, not yet unwinding the balance sheet, and this is what could be a differentiating factor.
Okie dokie. So I don't know. Everyone's got, some of these people got good points. I mean, I get it. The consumer appears strong if you just want to be in a vacuum, but I mean, they're strong until they're not. And that's why, see, the thing is, guys, is that's why interest rates get slashed 200, 300 basis points. Something horrible happens. Now, real quick, Comment, I don't know where that list is, bro. Can you comment and let me know where that list is? So going back to what Comment was saying, here's the thing. Again, and this is a very smart person. I know, he's very analytical. So, and no one has a crystal ball here. It's just about probabilities. And I think, honestly, what we're saying on the channel has a higher probability. But again, Comic's saying we got one more last opportunity. So if you're on that side of the fence with Comic and you're going to go buy, during this winter season, and because I may buy this winter season, I'm looking every single day, just make sure you're purchasing with the proper fundamentals, because they really, really matter right now. Wedge, cash flow, proper expectations, right? Getting a great deal, not using your emotions, using the data to find the deal, holding it for 10 years, right? Things like that, having 6 months of reserves, 25% of your income. I mean, I would throw out a list. If you're buying like that, you're going to be better off. But his thing is like, okay, that's our last opportunity, because the rates are going to cut and it's not necessarily going to be from unemployment. But here's the thing. Here's why I don't buy into that. And yeah, sure, I could be wrong, but here's why I don't buy into that. The inventory is coming. If we didn't have these STR bans, which, by the way, they're cracking down, the enforcement of the STR short-term rental bans has been difficult because there's so many loopholes. Essentially what's happening with Airbnb is the owners of those Airbnbs are screwed. Okay. A lot of them can't even cash flow long-term rentals. So instead of doing the right thing, like figuring out a permanent solution, the owners are taking them off of Airbnb and listing them on other sites like Facebook Marketplace. If you don't believe me, go to Facebook Marketplace right now and type in Airbnb. And you'll see a bunch of people have stopped listing from Airbnb because they're getting cracked down from these metro areas. And now they're doing it there's basically a black market. So more enforcement needs to be done with the STR markets, but plus we have the sellers on the sideline. I don't know if I buy into the boomer thing. Apparently there's a whole bunch of boomers that are going to start selling. But the thing is like, with the economic uncertainty, with people hurting, with the fact that people do have money in their house, people are going to want to sell their house. I don't think this is anywhere close to our last opportunity. I think the best case scenario to what Comic is saying is it's just going to be sideways next year. I think that is the best case scenario for the more, and I'm not saying Comic is necessarily bullish, but for that more bullish narrative, I think that's the best case scenario. Again, we have inventory that's coming. We have the uncertainty that's also coming. Commercial real estate meltdowns, so many meltdowns in the front end of a recession. Basically, you guys, when it all said and done, you know what? And let me actually go into this next. Let's go into this next part because we're going to talk about this right now. Because really, I have basically separated this out to one thing. So the primary difference of bulls and bears when it comes to the housing market is only one thing, and I'm going to get to that right now. But first, let me show you this, okay? This is the effective federal funds rate. All right, here's what I want to show you, okay? So we had to shoot way up here, okay? Now, look at the GFC, first of all. Now, remember, the GFC, the federal funds rate was 5.26. But unfortunately, unemployment became unhinged. Okay. And the Federal Reserve was like, oh, crap. And look at this, guys. They did what? Freaking 500 points of rate cuts. Did y'all know that during the great financial crisis that the federal funds rate was under 1%? Raise your hand if you knew that. You didn't know that. You didn't know that. Okay. Now, you probably are asking, wait a minute. The federal funds rate was that low for decades. Why weren't the interest rates 2 and 3% like they were right here? Remember, this year we had 2 and 3% interest rates, and it screwed us bad. Back then, the federal funds rate was just as low. Why were interest rates high? Okay. I'm going to show you that in a minute. But first, I want you to understand that even though the Federal Reserve cut 500 basis point cuts in 2008, 500 basis point cuts in 2008, it was not enough to stop unemployment. It was not enough to stop it because it had already started. You can't just stop unemployment. It is a domino effect. So even though they cut that 500 basis points, now I understand that things are different. Things are different right now. As far as consumers, as far as equity, as far as the type of loan qualifications, QM mortgages, things are different. My point in showing you this is even if they cut rates, the moment that unemployment becomes unhinged, it's not just going to stop. Okay? It's not just going to stop. So again, federal funds rate was under 1% at the beginning of 2009. That's crazy. Now, again, here's what I want you guys to understand. Lenders can't afford to lend at these low interest rates. Lenders need to be able to sell these low interest rates to the government. Let's just say Fannie Mae and Freddie Mac, okay? Now, they do that like this. Mortgage-backed securities, all right? Now, if you look here, the government, this is the mortgage-backed securities held outright, okay? So if you look here, they started purchasing mortgage-backed securities when? January of 2009, and that is why those interest rates were, the federal funds rates was able to go that low. Now, the reason why the lenders did not drop rates to what they were right now is because if I were to guess here, it's because they were all insolvent. There was a horrible banking crisis back then, and essentially, I believe they needed the profits. But nevertheless, what I'm saying is anytime the government starts purchasing mortgage-backed securities like this, it artificially lowers the interest rates, and it embeds that into the bedrock of our economy. Okay. So again, you see that here, even though the rates plummeted right here. Okay. As consumers, we didn't get that. All right. Look, we got it right here. We got it here, but we didn't get that right there. And again, remember, they were able to do that because the mortgage-backed securities were being purchased. Now, the good thing is the government stopped purchasing mortgage-backed securities. Now, again, if there's one thing that separates us, if there's one thing that you want to watch, and only one thing, if you guys just want that one thing, what do we watch? What is the main, when all of this said and done, the 5-year break even, the inversion of the yields, the M2 money supply, the reverse repo market, the 10-year, blah, 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 blah. There's one thing that matters. It's this: unemployment. As far as, just to kind of sum this up and simplify this, this is the biggest hurdle between bears and bulls. This is like, okay, the housing market's going to crash, or, oh, the housing market's not going to crash next year. Everything, in my opinion, is hinged on unemployment. Everything, guys. If you want to watch what's going on, if you want any indication of what you should be watching, it's probably unemployment. Because remember, what is spurring everything? It's the consumer. 70% of GDP consumers. Consumers are also what? Paycheck to paycheck, 60%. Paycheck to paycheck. You guys, there are so many homeowners right now that purchased in the last 2 years, not prior to 2022. Those people are okay. But there are millions and millions of Americans that purchased within the last 2 years that are overextended, that can barely afford their house, that have no ability to sell or rent because they do not cash flow and they do not have wedge because they purchased that house with the fear of missing out. And whether unemployment goes up or not, that's a fact. They did purchase out of the fear of missing out, and they did settle, and they are overextended. And those are things that we know. So the slightest variance in income is going to devastate a portion of recent homeowners. And I also want you guys to understand, this is what unhinged looks like. They cannot stop it. Again, it's fine. Look, going into the financial crisis, the great financial crisis, the unemployment rate was going down in 2006. Do you hear me? You guys, the unemployment was going down in 2006, and it looks like here the start of 2007. This is employment going down in the front end of the recession, just like what has been happening right now. And then look at, oh crap, it started to break. Unemployment spikes up all the way to 10%, despite the federal funds rate dropping to 0.15. They cannot stop unemployment once it starts. So again, that's what I'm saying. A lot of what bears and bulls, if we were to just look at one thing, it's the unemployment right now. And I'm going to tell you guys, it does become unhinged. It is very hard to get control of that. So again, if they cut interest rates significantly in comic, I don't know where that list is. I haven't been looking at the comments because I'm talking about significant rate cuts, right? They may not do significant rate cuts. Maybe so best case scenario, inflation is more under control and they do tiny little baby interest rate cuts. But the bulls are like 250, 350 basis point cuts. And I'm telling you guys right now, that's not going to happen unless there's unhinged unemployment. So anyways, we're going to go on to our next video. I love this video. This is from Ivy Zelman. I really love listening to her. She's going to basically kind of just confirm like, hey, unless the interest rates go down a whole bunch, it's not going to really impact the housing market. Okay, she's not going to really go into unemployment too much, but here's our next video. I hope you guys enjoy it. I like this one.
Just heard housing starts grew 1.9% in October. Join us now for more on the state of the sector and what we could see next year. Ivy Zelman and Associates CEO. You were on Squawk Box. We shouldn't talk here, should we? Back when you were at Solomon Brothers.
Yeah, it's been a long time.
A few years, and then you started your own company.
Yes, 2007.
2007.
Yep. It's been a while.
Still interested in housing. You're interested in
love housing.
So these numbers, listening to Diana, there are a lot of cross currents because rates are definitely higher. But her point was that some of the new home builders seem less sensitive than. They're still building away because the supply issue is still with us. So they can still do this and expect to sell things at these rates. They're not being hurt by this.
Well, I mean, overall, the builders have had more resilient sales. And I think part of that is also they're really offering great value to the consumer by giving mortgage rate buy downs. And that's enabling the buyer to have less stress on affordability. So they're buying rates down as much as 2 points. And that's obviously pretty helpful. They're offering incentives and they've got product. And while they're providing that incentive and that could impact margins, they have product where incremental demand, there's not a lot of existing inventory.
We've seen rates come down. When do we see, is that going to be enough to get existing sales going again? Will people feel better about it? Has there been a lull because of the rise in rates at this point?
Absolutely.
Yeah.
I mean, existing home sales are right now probably at the lowest since the GFC. If you look at, 4 million roughly existing home sales as a percent of households, it's kind of 3%.
Great financial crisis?
Sorry? Yeah, at the GFC,
Okay.
sorry.
Got
Yes.
it.
Great
Got
financial
it.
crisis. But I would say that rates today, the average homeowner is more than 80% or below 5%. You've got almost half below 4%. So when you start looking at that, we need a lot further decline in rates to reignite the existing home market. So I think it's
nobody wants to move. That's why there's no
inventory. It's a disincentive.
You've got a mortgage below 3 or 4%.
Right.
So this isn't going to work itself out anytime soon. You don't think you think 2024 flat? Nothing.
Yeah, we're looking at flat. I think the new home market just down slightly, but with respect to kind of what unsticks the market, I don't know. I think you've got the risk of distress. Looking out further, you kind of look at the aging population that would help move some people out. Vacancies would rise.
2026? No, 24. After,
by 2030,
after 24 is 25. It's much better in 25. And you already in your business, you have to be able to make determinations about something that far off. And you
well,
do.
we try.
Yeah. And much better for 2025, a rebound even.
Well, 25, we're looking for a reacceleration off a very low base for existing home sales, only up 7%, but it still would be on a relative basis extremely depressed levels.
So when does the shortage of just new homes or even existing homes, how does that finally work itself out? And what year is that? Or does
well,
it?
I mean, the problem is that land prices have been accelerating. There's been no let up in land. Inflation continues to rise. So with respect to affordability and providing more affordable housing, that really without any government support, developers just can't pencil returns to provide enough housing that's needed. The multifamily market right now is seeing deceleration in rents because of so much supply that's coming to market. And that's putting, will provide consumers
That's the
some
thing
relief.
you asked me for. You wanted to know if we had the figures on multifamily.
Yeah, on
right?
multifamily, how are the numbers there?
What? I don't. Diana,
we were
look what
looking.
it-
We were.
I
Looking
was
for a
listening, but I
big
didn't hear.
decline.
I didn't memorize everything they
We
said.
were looking for a pretty steep decline, over 30%, because right now developers with the cost of debt, it just doesn't pencil for them to start multifamily construction. And that eventually there's 1 million units that are in backlog, which is actually the highest since the 1970s. So about over the next 2 years, as those units complete and come to market, it's going to continue to put pressure on lease rates, which ultimately, with starts plummeting, that will allow for reacceleration in starts. But for right now, I think starts are going to remain pretty depressed in multifamily, where we think there is an oversupply.
And home improvements, crappy.
I mean, it's decelerating, it's weakening. And from what our surveys show us, that we're really now below where we were in 2019. So we saw beyond normalization to pre-pandemic. And I think that, it's a
Anything
consumer
that you
wallet.
say to our viewers, buy immediately, whether it's the
I
builder.
mean, within housing,
Yeah.
I think it's a pretty tough time right now. I mean, we had such a boom. And if you look at where the consumer's wallet, their spending was so significant. They call it the honey to-do list, everything that we did while we were locked up at home. We're just seeing more wallet shifting to other areas, whether you talk about hospitality, travel, service. It's just not in the housing market as a priority.
When rates go up, it's just bad.
All right, guys. Interesting video. Always nice to hear from the, really smart people, really important people. Hey, couple things real quick. Who dat ghost? Dude, you're such a creep, man. Why are you even here? But anyway, I see you trolling, but I still appreciate you being here, man. So Who Dat Ghost says, you always say, don't fight the Fed. He's a fight the Fed guy, just like the market. That's okay. Can you repeat for me the 2 main goals? So here's the thing. He forgot another goal, which is to lie to you. I'm going to tell you right now, Who Dat Ghost, if you believe everything that Jerome Powell is saying right now, you are so naive, brother. You need to wake up to reality. They're blowing us alive. And let me show you, let me pull up this now real quick, because I like Comet's saying. So because I think about what I respect Comet enough, you guys. I respect Comet. Like the other guy, Who Dat Ghost, is a troll, pretty much useless, hopeless as well, probably. But Comet Glover, him and I don't see eye to eye, but at least we can communicate with respect, and I really appreciate him because I actually think about what he's saying. So this is what Comet is saying. There's no way they're going to allow unemployment to become unhinged in an election year. That's probably why they're flooding the job numbers with government jobs. I don't know. But the thing is, man, you're assuming that they could stop it, right? Is that correct? You're assuming that they could stop it when we go back here, let's go back here real quick. Okay. When we go back here, once again, we could see that, first of all, do you think that they wanted it in 2007? Do you think that they wanted the house market to crash in 2007? I don't think they did. At least the Ben Bernanke was saying they didn't. And also, Who Dat Ghost, will you believe Ben Bernanke when he was saying there's no subprime mortgage crisis? Were you one of those people? There's no subprime mortgage crisis. Just keep buying. I mean, think about what you're saying, man. My God, it's like, wake up. Why do so many people? Anyways, so look at. They lowered it to try to stop it in the mid 2007, and they kept the federal funds rate way low. Look at under 1%. And on top of that, the amount of mortgage-backed securities that they purchased was even more. The trajectory was even greater than COVID. It was even greater than COVID. They bought more mortgage-backed securities during the great financial crisis than they did during COVID. And we think that the government can stop the meltdown from happening. I don't think so. I hear you, though. I hear what you're saying. I am concerned about the election, but I don't buy it. I just don't. I hear what you're saying, though, and it does worry me, and I do think about it. I do think about that. So I won't say I won't think about it. But personally, I don't buy it. I don't think they can. I think things are so messed up right now. I just don't think that they can do it, man. I hear what you're saying, though. I hear what you're saying, and I definitely appreciate it. Now, real quick, guys, I'm going to go into one last video. But before I do, let's play a trivia game. Because I got a comment. Let me pull up the comment real quick. Good stuff, House Hacker. Good stuff, Comic. Those are my guys right there. I love those guys, both of them. And I'm pretty sure we all respect everyone as well. So where is the comment? Oh, yeah. Okay. So here's a comment here. Why were those 4 people in the intro with the X on it? Should I be aware of them or something? I follow one of them. Real estate agent in my state. So here's the thing with those X's, just to clarify, those used to be those are some of the top real estate YouTubers. And, here's the thing. A lot of them started the whole Crash Bro things. A lot of them were bullying us. A lot of those people that are X right there are the people that I believe who, at least on YouTube, who were saying continue to buy. The Crash Bros are stupid. So I don't know whether or not you should use them. If you prefer people to just flip-flop like that and bully other people that are trying to be cautious, go ahead. But to me, I'm going to remember what they said, and I'm going to hold their fire to the feet, because they disrespected us, they bullied us, they embarrassed us, and they caused an overwhelming amount of people to disregard caution and purchasing real estate the right way. So I just want everyone to know that I remember them doing that, and I especially remember it, and it especially hurt me because I used to watch them. I looked at them like my peers and I respected them. So when I saw that they were just hollowed out salesmen and women, it's heartbreaking to me. It's heartbreaking. But anyways, that's that. So we're going to play a little trivia game. I don't want to use any names here. So I'm going to throw up a clip, and I want you guys to guess the YouTuber that the clip belongs to. Okay, just one trivia game. That's all I want to do. All right, so I'm going to play a clip. It's from Seinfeld. Okay, it's just a Seinfeld clip. And I want you guys to guess what real estate YouTuber I'm talking about. Whoever gets it first wins. So get ready. I'm going to play the clip. Whoever says it first wins. Who am I talking about? It's so weird. What's with the dancing? I don't know. It's weird. Anyone guess it? Anyone? No? Anyone? Let's see. I don't see anyone. Yes, obviously that's Elaine, but what YouTuber is Elaine representing? It's so funny. Why the weirdo dancing? I don't know, guys. I mean, no one's going to get it, huh? Okay, that's fine. No. Me, Kevin, are you serious? No. It's best if you guys don't. If you guys don't know, then all I'm doing is sparing you the cringe to have to witness that. Mr. Beast, that's funny. Orlando, get me, dude. I do look like that when I dance. That's funny. You guys, we're gonna go into one more video. The video that we're gonna go into is from the Boston Federal president. That's basically saying to Comic Lover and House Hacker, you guys need to chill out. The victory is not, and they actually use Comic Lover and House Hacker by name, and they say, calm down. We're not in victory. So listen to these guys call out House Hacker and Comic Lover. So House Hacker and Comic Lover, this one's about you, okay? Here it is right here. I love you guys. Just know that.
Hey, Carl, perfect setup for the interview we're about to do here with Susan Collins, the president of the Boston Fed. Thanks for having us. We are here in the gorgeous Boston Fed building here.
Well, thank you for being here at the Boston Fed for our 67th Economic Conference.
Wow, I think I've been to a bunch of them. I don't think about 67, maybe 20 of them. Let me start off with the most recent inflation report, which beat expectations and really caused the market to make this shift of thinking, well, maybe or maybe not the Fed's going to hike, to Fed looks really certain to cut. What was your reaction to the inflation report?
Yeah, so let me say three things about that. The first one is that, some promising news there. We are seeing some moderation in inflation, and I can certainly talk more about some of the details, what we're seeing. We're also seeing some rebalancing in the economy more broadly. So, in terms of the inflation numbers, though, the headline came down, and partly for energy. But at the same time, data is so noisy right now. And the progress that we've seen has been pretty uneven. So just like I wouldn't overreact if things went in the direction that we weren't looking for, I don't overreact if we get some promising news. I think we're positioned to be patient. And the 3-month core is still at 3.4%, Steve. That's higher than we want. And so in order to get back down to 2% in a reasonable amount of time, we need to be patient and resolute. And I wouldn't take additional firming off the table. We need to look holistically at the data. So promising news, which is great, but I remain focused on really looking at the kind of full complement of information that we're getting and making assessments in real time about the right thing to do.
So just to recap, the market reads this number and says it's off the table. You read this number and you say it's not off the table, which is sort of saying, like, is the market making a mistake, or did it go too far in saying, oh, by March or May of next year, you're going to be cutting interest rates?
So I understand a tendency to really enjoy good news, and there is some good news in some of the numbers, and I think that we need to appreciate that. But I don't see additional firming off the table. I think a key point is we need to really stay the course, and we are seeing that the work that we've done is feeding through the economy. We're seeing some broader evidence of rebalancing, in particular in labor markets, and that's really important. And so there, again, I think it's important for us to be patient and recognize that far from declaring victory, there are parts of the inflation numbers. Good price inflation has come down substantially, reflecting improvement in supply conditions. That's actually back to pre-pandemic levels. We're seeing some good news on the shelter price inflation, but got to watch rents in particular, because that's been very uneven, and we need to make sure that the moderation there is sustained.
Yes.
And while we've seen a bit of good news on the non-shelter services, there's really more to do there. And so I'm being patient, looking holistically at the data, and welcome the promising signs.
You've used that word holistically a lot. I just want to ask you, though, about a month ago, you talked about higher interest rates doing the work for the Fed. Those rates remain higher than they had been, say, in the summer, but they're lower than they were when you made that comment. Do you still see that interest rates are doing some of the work for the Fed?
Yeah, so it's certainly the case that, for example, longer-term treasuries has come down since the last FOMC. So there's movement in there, and it's kind of hard to predict exactly where that will go going forward. I look overall at financial conditions, and we are seeing that credit conditions, there is some restriction there for firms that are bank sensitive, and a lot of the firms have very strong balance sheets, and so are less so, and also for households. And so I am seeing evidence of the kind of restrictiveness that's consistent with the orderly slowdown that we're looking for to realign demand with supply and continue the inflation moderation that we need to bring inflation back
to bring inflation back down. So let's see here, guys. That is going to do it for the video portion. Let me throw up some comments now. Hope, the rental market, right? The rental market. We need to pay attention. I mean, I like what she was saying about the rental market. The rental market was declining. It appears to have like a slight potential rebound. So, I mean, what do we want to act like? The Federal Reserve doesn't understand how bad the housing market is in? The prices are not at 7.4 PE ratio. We can just act like they don't know that? We're going to act like they just don't know that. I mean, come on, guys. I mean, it's my child knows this. My 8-year-old, she's turned actually 8, but she knows this. Holy smokes. How do people not know this? Okay, so some good stuff here. Let's pull this up. Let's see here. She started it. Sorry. All right. Let's pull up some good comments. And I'm going to continue to hold their feet to the fire, guys. I cannot wait to just hold these guys' feet to the fire. I am tracking them. You know what I'm going to start doing? And here's why. Okay. Living in Omaha, David, here's why. Okay. Some of these guys are using fake data. They're using data on a national average, and they're using specific market centers to push their narrative to get you to buy a house. If they were honest and had a real separate opinion, like, for example, Meet Kevin, and I get roasted all the time because I listen to that guy. If they had a legit argument and they were using legit information, even if they were interpreting it wrong, okay, fine. But these guys are staying crooks. They're robbing people because they're lying about the information. Now, if they want to be overly optimistic, that's fine. Be overly optimistic. But if I hold something up and say, this is why you should buy a house, and this is fake and this is wrong, then they're liars and they're criminal, in my opinion, because the purchasing of houses is hundreds of thousands of dollars. So if you're intentionally lying to people, like you're lying to people, not you misspeak or you just don't know, you intentionally lie, and I know that because they go back and edit some of their videos that I was actually going to record, then you're a crook. Then you're a crook, in my opinion. And how many of these people link the data? How many? None. Seriously, I don't even know one of these guys that links the data. I don't think any of them link the data. So I'm going to keep going, man. I am not going to hold back. And I'm going to tell you that right now. I'm not going to hold my punches anymore. I did that. It was a huge mistake. People are thinking, oh, Travis, you're starting to question what you believe. No, man. I mean, I've been burnt out. I've been holding my punches back. Here's the thing, you guys. I get a little depressed when I don't challenge myself. So that's one of the reasons, why I'm going on this traveling. I'm going to be taking, after Thanksgiving, a 16-day road trip. During the 16-day road trip, I'm going to be giving you guys videos on 10 different metro areas around the nation to where we're going to be exploring new construction. Again, 10 metro areas in 16 days. I'm also going to be doing 8 live streams during that time. I love the challenge, you guys. I love the challenge. If I'm not being challenged, I mean, I just get bored and I don't get motivated. So I hope you guys are the same. Anyways, let's throw up some more comments. Boom, 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 boom. So to House Hacker, always appreciate you got wisdom, brother. I know that. Don't take anything I'm saying the wrong way. I'm already seeing a lot of first-time home buyers that are currently priced out and spending their money on vacation, new cars. They're burned out. And that's what I'm trying to say. Like, don't lose hope. All right. Don't let these people bully us. Say, Crash Bros, if you didn't buy right now, you're never going to buy. Or, renting is so stupid. Like, don't listen to these bums, you guys. Don't listen to them. We already know historical precedent. If you're going to buy wedge, cash flow, 25% of your net income, right? Emergency fund, no consumer debt. Like, you got to do it the right way. You can't be falling for what most people are falling for. And what's happening, House Hacker, and this is what happened last time, is when people give up on owning a house, they're going to stop trying to own a house. And when they stop trying to own a house, they're going to start spending their money and they're going to stop caring about their credit. It happens all the time. And that is why when unemployment comes, it's unhinged because it's broken. And in order to fix unemployment, that's why the Federal Reserve normally, and you saw that, they drop rates like crazy because it's broken. So stands to reason they're not going to do that until it's broken. And whatever is broken, it's probably safe to assume that will create unemployment. Good point, House Hacker. Night Cry, appreciate you. Patience is painful, but pain is temporary. Glory is forever. And that's the thing. There's a reason why patience is a virtue. Patience is a virtue, okay? Take your time. And you don't have to listen to me. I don't know exactly when the housing market's going to crash. I'm trying to do the best I can. I'm trying to buy a house myself, and I'm being transparent about everything and linking the data. But it is very difficult to understand when exactly things are going to happen because of all of the excess money. You have to find that out for yourself. You can't listen to everything I'm saying. This goes to you, Trey, especially you, Trey. You need to learn. This is to you, Trey, and anyone that's a first-time home buyer. Okay. And I love you, Trey. And that's why I'm talking to you. If I didn't love you, I just want to talk about you. You have to be more confident in yourself, Trey. And you're probably confident in yourself. Okay. But you have to understand how to read the data in your local housing market. And you have to understand how to find that great deal. That's why I have my home buying course. My home buying course is not designed to generate me income. My home buying course is designed to help you understand the bare minimums of purchasing a house. Why would I do it for free? It's part of my way of giving back because I lost everything. And I don't want it to happen to you. Anyways, so boom, boom, boom. Don't forget. Okay, so don't forget the government redefined the word recession. That's true. But here's the thing. When I think back about they did redefine the word, the definition of recession, I don't care that they did it anymore. I don't care that they redefined recession because what is recession? It's one thing. It's the one thing that matters at this point. There's other factors that are contributing. So there's things that matter, but the primary thing is unemployment. So when we actually had the recession, there was no unemployment. So I get it. You know what I'm saying? So the unemployment is what we need. But yeah, they redefine that. That's crazy. All the bulls are saying demand will skyrocket when rates drop are missing the key point. The demand to sell will also skyrocket. Yes. Possibly more than demand. And that's the thing that I'm trying to say. Please, you guys, listen to what, I like your name, Travis. I have a similar name. My name is also Travis. I like what he's saying. Think about what he's saying. You know how many people are on the sideline right now that want to sell their house that just can't afford to sell their house? There's probably millions of people that would sell their house if rates were, say, dropped to 5%. But also remember this, and this is why I don't think we just have one more opportunity. I think we're going to have several opportunities for several years because not only are we going to have that golden handcuff effect removed. Remember all this talk about golden handcuff? When rates go down, the golden handcuffs goes away, but they have to go down significantly. You guys, we're going to also get inventory from other places, STR bans. Let's not forget that Airbnb is under attack. Everybody, and the insider trading right now is almost $1 billion. The co-founder is selling millions of dollars of stocks right now. Right now, we're going to get inventory from there as well, plus new home builders. How many times have I said there's way more inventory than what they're actually reporting? And whether it's on census data or MLS, there is so much more inventory than people realize. Now, builders are better able to cushion to hold longer, right? But regardless, you guys, another thing with the builders, we see the price crashing. It starts with builders. What do you make of the price crashing with the new builds? Comic, House Hacker, they're in places that are tight, but in places like where I'm at, like in Texas, what do you make of that price crash? And think about this, House Hacker, Comic. How can you explain the price crashing with new homes, okay, 15.7% down from October, on top of ridiculous buying incentives and buying incentives that are hidden that would normally reduce value, and yet it's still down 15.7? There's one reason. There's one reason that's down. Inventory. Inventory. Despite what you hear in the media, oh, they can't build enough, the demand's too high. BS. That's what we got to look at, supply, not actual units. The supply is 6.9 months. It's probably going to revise upward, to be honest with you. It's 6.9 months. A balanced market is 4 to 5. It is a buyer's market in new construction right now. It has been. And remember this, the bad stuff happens first with new construction and generally spreads over to existing mortgages. So again, you guys, it's just another reason right now that we should be patient, on the sidelines, improving our credit, our income, and our assets. But yes, lowering rates will also have demand come off of the sidelines as well. Okay, let's see here, you guys. Okay, so this is interesting. So Les, appreciate the comment. Lenders don't care about the interest rate. Their money is made on closing costs and fees. I got to tell you something, Les. You guys, it's way worse than you think. All right, here's another thing. Comic Lover, House Hacker, I hope you're on still. I want you guys to comment on this, okay? Let's talk about mortgage-backed securities, okay? Because Les, you're wrong, brother. What you're talking about is probably mortgage companies, okay? Like mortgage lenders, not actual servicers. The servicers are stuck with the bags. The servicers are the people that get paid from the interest. Generally, the mortgage companies, he's right, they do care about interest rates because they want to do business, but their money is primarily made up front, closing costs, fees, and things like that. And then the mortgage company sells it to Fannie Mae, Freddie Mac, or Chase, Wells Fargo, Bank of America. So here's the interesting thing, Les. It's actually the opposite of what you're saying right now. It's actually opposite. The big three lenders, Bank of America, Wells Fargo, and Chase. Okay, you ready for this? Okay, I'm going to tell you guys right now. Okay, this is what I heard. I need to do more research. 40% of their assets are tied into, okay, the big three, hundreds of billions of dollars. I've heard up to 40% of their assets are in mortgage-backed securities with interest rates under 5%. Under 5%, 40% of their assets are mortgage-backed securities. Why is that important to know? Because those rates are too low. They're losing money. Essentially what I'm saying is the banks are insolvent and the Federal Reserve knows they're insolvent. One of the primary reasons is those mortgage-backed securities. The mortgage-backed securities that the big three hold right now, you guys, are the low interest rates that are they're killing the banks. We've already seen bank runs as a result of the systemic failure of the high interest rates, but we did not see it as a result of mortgage-backed securities yet. We saw it as basically the treasuries, right? Unrealized losses. There was a bank run. They cashed out the money to pay the depositors. They took massive losses. But don't forget, you guys, there's also the problem of unrealized expenses with, well, per se, not necessarily unrealized expense, but mortgage-backed securities, okay? 40%. They still have an overwhelming amount. So Les, I'm going to tell you right now, brother, they really, really care. They really, really care about what the interest rates are, specifically Bank of America, Wells Fargo, and Chase. They are, I'll say it, they're insolvent. They're insolvent when you look at the liabilities. We'll see. We'll see. Okay, so here we go. Okay, how does a bag holder who this is a good point. This is what David is talking into what I just said. How does a bag holder who finds himself owing 3 to 5% mortgage-backed security compete with someone getting 5 to 16% interest on the low risk debt? On the short end, The 30, they're getting 2, 3, 4% on the long end of the yield, the 30-year, right? We can get 5% on the short end. They can't compete, David. That's the thing. They're losing money because they want people to buy, to sell their house or refinance, so they get the money from the MBS, and then they could take that money from the mortgage-backed security and they could just buy bonds, treasuries, and make more money risk-free. Crazy. Travis, I would love it for you to interview someone that disagrees with your view on the housing market. Your combination is great, but seeing you debate with the opposition live would be interesting. I would love to be honest with you. I would love to do that. So I think that would be so great. Here's a couple problems. If you guys know someone, or maybe you disagree with me, email me. I would absolutely love to do that. But here I have a couple conditions on doing that. You can't be petty. You actually have to believe what you're saying, and you have to actually use the data. Okay, so if you guys know someone that disagrees with what I'm saying, but is at the very least, genuine with their opinion, I love it. Be genuine with your opinion and we'll talk. Use the data. But the problem that I see, brother, is most of the people that we would assume that could debate with me are nothing better than washed up lead generators. They don't even use the right data. Who am I supposed to debate? Christina Applegate, or whatever her name is? Am I supposed to debate her? Jeb? Are you kidding me? Jeb doesn't even know what's going on. He's just using random stuff, from what I can see, random stuff he finds on the internet and puts a video together. He talks real slow, real elegant, but the data's not real. What am I supposed to do? Do you guys really want me to talk to these bums? I mean, I will, but that's the condition. You got to generally believe what you say. I will respect it. I don't respect the lies. And again, a lying is not something you don't know. A lying is knowingly misleading. It's not just because you don't know. I don't think that's lying. Just think you just don't know. That's fine. But I'm talking about lying, and that's not cool. All right. My man got it right. He was the first person to say the name. All right. Someone said lady with the purple hair. My man, you got it right. Well done, sir. Well done, sir. All right. One more super chat right here. Appreciate you, brother Travis. Is this a good time to buy my first? These questions. Is this a good time to buy my first ever home in South Florida? If I was planning to buy a duplex to live in one and rent the second out. So what they're talking about is house hacking. And you've given me none of the things that I had just mentioned. You've given me none of the things. You're just simply asking me if it's a great time or if it's a good time to buy. I want to say this, and please thank you for the support, brother. And I really want you to pay attention to what I'm saying, okay? Let me say this first. Can a small fraction of people still find great deals? Yes, I believe so. I believe you can still find, not in every place, in some sections, you could still find houses right now that are a great deal with wedge and with cash flow. In fact, I've showed you that on my market analysis on my lives, which, by the way, I got to do that again. I've already showed you that. I could find houses listed at 2021 values right now. The thing is, you're asking me if it's a good time to buy. That depends on you. Overall, hell no, it's not a good time to buy. Not even close. I'm saying overall, my man. I'm saying overall, it is a horrible time to buy a house. In fact, I think it's dangerous. I think people are naive, and I think they're unrealistic if they're blindly buying houses. However, it's a great time to buy a house when you find what you're looking for, as long as it matches up to your goals, as long as your goals are financially responsible. So, brother, if you find a house tomorrow that has, say, 20% in wedge, that cash flows $700 a month, you don't have any consumer debt, no more than 25% of your income is going to the mortgage, see you, brother. I wish you luck. Enjoy your home buying journey. Make sure to talk to a CPA, see if you can do that tax deduction on all that interest. And I wish you the best. You see what I'm saying, brother? But if you don't understand wedge, cash flow, and things like that, it's not, in my opinion, it's not. Now, brother, again, go to my community tab. I'll probably make another post. Just take my home buying course. It's free. Just go to the site that says wedge. It's not even that difficult. It's just a basic general knowledge on about, 14 or 15 different categories. My friend, I need you to be empowered. I need you to be empowered. I want you to be empowered. I want you to learn these things, because if you knew those things, you would not be asking that question. These questions concern me because it's not talking about those really, really important things. And I really appreciate you. Again, I would just not have brought this up and talked to you if I didn't appreciate that. So I appreciate you, man, very much so. I hope that explained that to you. This is running a little bit long today. All right, so let's see here. Boom, 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 boom. Big shout out once again to House Hacker. Big shout out to Comic Lover. I want you guys to continue to speak your minds. I want you to continue to throw down what you believe is going to happen. I really value these guys, so much. You guys help make me stronger, especially when we don't believe. I can't always, by the way, House Hacker Comic. I can't always research what you guys are saying, but when I can, man, I definitely appreciate it. Big shout out also to my man Trey. This is the guy I'm watching. This is he's along with the group, the Vital Sign, Jeff, Johnny. I care about you, Trey, because to me, you're who I'm talking. I'm never talking to investors, people with a whole bunch of money. I'm talking to people like my man Trey, first-time home buyer, and he's empowering himself. This man, how much did your credit go up, Trey? 40, 50 points or something like that already? I'm talking to you, Trey. Everyone else that's listening is just along for the ride. I care about you. Sorry, investors. Sorry, I care about you, brother. I want you to win. So big shout out to him. He set up the Discord. Jackie, it's nice to see you, Jackie. Nice to see you. He actually joined the live. Just really appreciate everyone here. I'm not going to, oh my gosh, Christina's here. Okay, let's see what she has to say. Good morning. Can I ask why my face is on your latest thumbnail? I know it's my title you use, but why use my face? Christina, listen to this podcast. I made an announcement to you. And by the way, I made a clip for you. Take a look. That's for the Crash Bro comments. That's all. It was for the Crash Bro stuff. I see your comments, Christine. I see your comments, but that's why I did it. So, all right. Glad she got that message. Anyways, guys, I appreciate you. I think that's it for the shout outs. Les, always appreciate you. Yes, I think we should. Christina, if you're still there, you know what? I'll make a deal with you. I will dance. I will dance like Elaine. I will dance like you. If you want to do a live stream with me, even if it's not, it doesn't have to be a live stream. Honestly, guys, I'm going to tell you, even the people that I believe are misleading, tremendous amount of people, even those people, I could be wrong about. Maybe they don't intentionally do it. I still leave reservation, even for second chances. If these people are real and I'm wrong, I'll say sorry. I would love to work together. I'd love to be genuine, but what I see is disgusting in my opinion, and that's why I have an issue. But I would actually really love that. I'd actually really love it. Because you're dancing, Christina, because you're dancing. But I would really love that. I would really love it. And again, as long as it's respectful, if we could be respectful, if we could use the data, I would absolutely love it. And I think that our viewers would love us talking. So yeah, anyways, just email me. I appreciate you guys. Hopefully I'll get that email. And other than that, guys, if you're out there investing in real estate, 100% that I wish you luck. And Trey, first-time home buyers, be careful at these overly optimistic YouTubers that are generating leads, that are demeaning us for being cautious. Be careful. They're hiding behind things like the word affordability, but their goals are to profit off of you. Don't forget that. And other than that, guys, obviously, I hope you win.